Hello everyone and welcome to our latest Bucks Trustee Network webcast. We're delighted today to be joined by Jo Goodsell from Saffery High Wycombe, who's a senior manager over there, and is going to be talking to us about the essential reporting requirements for trustees and giving a bit of an overview on the subject of reporting. So thank you and welcome, Jo. Thank you for joining us, and I'll hand over to you.
Thank you. So firstly, to summarise what we're looking to cover today, charity size and reporting. So I've been given some steers to the audience prior to today, and I'm going to be primarily focusing on charities which are registered in England and Wales and which are unincorporated. But just to be aware that if you've got a corporate charity, there are additional requirements. And if you've got a charity which is registered in Scotland, the reporting requirements linked to a charity size, they are different. Then we'll look at annual accounts returns, what's defined as a larger charity and the additional requirements, trustee annual reports, the different types of fund, serious incident reporting, and then we'll look forward to some imminent changes which are on the horizon. Charity size and reporting then, England and Wales. If your charity has gross income of above £25,000, you must get the charity's accounts independently examined. In terms of who can do that examination, if your gross income is above £250,000, you need someone who is professionally qualified, so ACCA, ACA for example. You have more flexibility below that level. If your income is not more than £250,000, you can adopt the receipts and payments basis for your accounts, so basing those on cash in and cash out. However, once you get above that threshold, there is no choice. You must prepare your accounts on an accruals basis. The threshold over which accounts must be audited for charities is gross income above 1 million or gross income above 250,000, but assets over 3.26 million. And then finally, if you've got a charitable group, the threshold over which you need to prepare consolidated accounts is £1 million gross income. So an independent examination is far less involved than an audit. To give you some idea of what you can expect, your examiner will want to test significant items of income expenditure, get comfortable with your balance sheet, make some inquiries around going concern, subsequent events, etc., and confirm that your accounts have been prepared on in line with the charity SORP. If your gross income is below £25,000, you don't actually need to get your accounts externally scrutinised at all. An audit, however, is far more involved both in terms of time and cost. And just a caveat here, always consult your charity's governing documents. In the end, if you're below the audit threshold here, but your governing document says, yes, you must have an audit, there is no choice. The thresholds go out of the window. So moving on then to annual accounts returns, these must be submitted to the Charity Commission online within 10 months of your financial year end. If your charity has income below £10,000, you only need to report your income and spending. If it's above 10,000 and below 25,000, you'll need to answer some more detailed questions about your charity. If your charity's income is above £25,000, along with the annual return, you also need to submit your trustee's annual report, accounts, and independent examiner's report or auditor's report. If your gross income is below 25,000, you don't need to submit your accounts to the Commission. However, should they ask for a copy, you are obliged to provide them. And if you've got any questions as to what's involved, there is a question guide and glossary available on government.uk. So, larger charities, England and Wales. The SORP defines a larger charity as a charity with gross income above £500,000. It's not the same as the audit threshold. Charities with income above this level must prepare additional financial statements, including a statement of cash flows, and comply with heightened government standards. They are also expected to disclose much more detailed information in the trustee's annual report. Trustee's annual reports then. This accompanies your accounts, and if you're a smaller non-company charity, so gross income below £500,000, you can prepare a fairly simple and straightforward report. This should include your charity's name, registration number, address and trustee names, structure and details of how the charity is managed, including how you recruit trustees, activities and objectives in the year, achievements and performance, including reporting on public benefit, and the key there is to give a balanced picture for the year. A financial review, including any debts and details of your reserves policy and details of any funds held as custodian trustee. If your gross income is above £25,000, as mentioned, you need to file that with the Commission, along with your annual accounts return. If your income is below that, you don't need to make any filing, but should the Commission ask for a copy, you need to provide it. For larger charities, the requirements are far more detailed, and I would direct you to the guidelines set out in the SORP. Funds then. So accounting for particular charitable funds is a key feature of charity accounting. Each class of fund has unique characteristics and trust form, and the charity's financial statements will need to report income and expenditure along with assets and liabilities by class of fund. You can see in the diagram there are two primary classes of fund, being unrestricted funds, both general and designated, and restricted funds. And I'm going to walk you through the definitions for each. So unrestricted funds, as the name suggests, are spent or applied at the discretion of the charity's trustees to further any of the charity's purposes. Designated funds, however, are earmarked. So they are funds set aside to be used for a particular future project or commitment at the trustee's discretion. The earmarking of these funds is not legally binding, and a designated fund remains part of the unrestricted funds of the charity. Restricted funds, however, are held for specific purposes which may be declared by the donor when making the gift or may result from the terms of an appeal for funds. These restrictions dictate how the charity can lawfully use the funds. So the key distinction there between designated and restricted funds is whether or not the trustees have any discretion as to how they use them. With restricted funds, the restrictions are legally binding, and usually to use them for another purpose, express permission from the donor would need to be sought. Finally, endowment funds. A gift of endowment where there is no power to convert the income into capital is known as a permanent endowment fund, and this must normally be held indefinitely. Where trustees have the power to convert endowment funds into income, such funds are known as expendable endowments. And I spent quite a bit of time earlier talking about the different size thresholds, which gross income is a key measure. When working out your gross income for the year, you don't include income from endowments. That is because it's not considered to be available to the charity to spend. Serious incident reporting. So you are required to report serious incidents to the Charity Commission, letting them know how they're being dealt with, even if they've already been reported to the police, donors, or another regulator. The responsibility for reporting these incidents sits with the trustees. While in practice this may be delegated, the ultimate responsibility is borne by the trustees to make a report and to do so in a timely manner. In terms of what we mean by a serious incident, some examples here: harm to your charity's beneficiaries, loss of your charity's money or assets, damage to your charity's property, or harm to your charity's work or reputation. The word significant should be taken in context of your charity's size, staff, operations, finances, and reputation. Finally then, looking forward, although not really looking forward because it's here, the charity SORP has recently been updated, and SORP 26 will apply to reporting periods starting on or after 1st of January 26. There's two headline amendments: revenue recognition and lease accounting. So revenue recognition has been brought in line with international standards. The changes apply where you accrue income over a period of time. It used to be accounted for according to stage of completion. It's now being accounted for according to performance obligations. Many charities, this will have absolutely no impact, but an example where it could impact you is membership income. So if the benefits of membership do not accrue evenly over time, and there are particular benefits at certain points in time, those would be considered performance obligations, and you need to consider which of those have been met in your financial year. Lease accounting, operating leases are coming onto the balance sheet. There are a number of exemptions. For example, if you've got a short-term lease of less than 12 months or low-value leases. Tiered reporting is also coming in. So what your charity has to report is going to depend on which tier it falls within. Tier 1, which I think will incorporate most of the listeners, is charities preparing accruals accounts with gross income of not more than £500,000. Tier 2 is up to 15 million, and Tier 3 is any charities with gross income above the Tier 2 threshold. Now, I've spent some time going through the size thresholds and reporting. These are actually expected to change. So changes to examination and audit thresholds, England and Wales, have been announced, with the objective being to reduce the cost and administrative burden of smaller charities. These changes are expected to come into effect on 30th September 26 and apply to counting years that end on or after 30th September 26. Strong caveat here, the government website still says expected on last check, so I cannot definitively say these changes are coming in then, but this is what we anticipate, and they are quite significant. So the threshold over which accounts need to be independently examined is moving from 25,000 to 40,000, and the audit threshold for income, for example, moving from 1 million to 1.5 million. So no, thank you. That's everything I wanted to initially cover. So very happy to take some questions, and I'll stop sharing.
That's great. Thank you, Jo. It's really interesting. And I had an immediate question just for myself, really, that just looking at designated funds. Is there a process that charities need to go through to designate funds? Like, so do trustees need to formally record that decision, for example? And then I suppose, can funds be undesignated?
Yes, I'll answer the second bit of the question first, if that's easier. Funds certainly can be undesignated. You can have general unrestricted funds that can be used for any purpose. In terms of process, that would normally be decided by the trustees at a meeting. So we'd normally expect to see some form of documentation via email or minutes or something to say this fund is being used for a particular project and purpose. And then your financial statements, your accounts would set out what the designated funds are, so what projects they've been assigned to.
That's great. It's very helpful. Thank you. So we have a couple of questions submitted from our network members, if that's okay. So the first one being, what is the easiest way for trustees to make sure their charity stays on top of reporting requirements?
I think that question is looking for one answer, but I do think it's a combination of things. Firstly, familiarising themselves with the reporting requirements set out by the Charity Commission, and including what and when to report. I mean, trustees should do that anyway in order to get comfortable with their role and the responsibilities, and when there are changes, keeping on top of those via training if needed. Secondly, if possible, I know it isn't always, but having a team of trustees with multiple skill sets. So someone with an accounting or reporting background might be more familiar with the requirements. And then thirdly, consulting externally when needed. So if a particular requirement is unclear, do seek further guidance. And that can be from an accountant, but it can also be from the Commission directly.
That's great. Thanks, Jo. And then a final question from our network is, are there any common mistakes that charities make when preparing reports or their annual accounts?
There is quite a number. Firstly, larger charities, because the threshold £500,000 isn't the same as the audit threshold, I think quite often charities don't realise that they need to make additional disclosures above that level, so there can be under disclosure. However, that should be picked up by their independent examiner or auditor. In terms of funds, which we'd already talked about, we do see most allocations between funds, particularly between designated funds and restricted funds. So there's a tendency to over-disclose in restricted funds when in fact for a particular pot of money there's no legal obligation to spend it for a particular purpose. It's been allocated to a project at the trustee's discretion and therefore should be designated funds and part of the unrestricted funds of the charity. Another mistake is not preparing a trustee's report that presents a balanced picture for the year. Serious incident reporting, failing to make a disclosure, which is then later brought to the Commission's attention by other means. In those situations, the trustees will need to explain why they didn't make a disclosure at the time, and that does have reputational implications for the charity. Not necessarily a common mistake, but failing to consult the governing document when deciding whether or not to have an audit. As mentioned, there are size thresholds which mandate an audit, but your governing document in the end is gospel. If that says you need one, you need to have an audit. And then finally, those who are more familiar with company non-charity accounts are probably familiar with the 2-year rule, whereby you have to breach size threshold for 2 years before needing to have an audit or a particular level of assurance. There is no such rule for charities, so the thresholds do only look at the year in question.
Great, thanks, Jo. That was really, really helpful and really insightful. And I'd like to take the opportunity to say thank you for your time today. It's been really useful. It's always good to keep on top of these sorts of rules for charities. And I know lots of our network members will be really pleased to have had the opportunity to listen to you today. So thank you very much, and yeah, cheers.
No, thank
Goodbye.
you. Appreciate speaking to your audience. And if there are any further questions, I'm always happy to take a call, or you can reach me via email.
Brilliant. Thanks, Jo.
Thank you.